Good morning, everyone. So, yet another session on financial instruments. Yes. So, yesterday we had ended at segregation of liability and equity. We had done one question, particularly when there is an early redemption. Okay. So, towards the end, we had written the steps. The first one being determine the liability component on the date of early redemption, that is via an amortization table. Then we had a step 2, equity component ledger balance on the date of early redemption, which is from the initial recognition entry. Step 3, split accounting of early redemption price, that is what is the amount you are going to get on account of early redemption. That value is clearly towards both the equity component as well as the liability component. So we will have to split that. So when we split that, how do we do the split? Do we do it based on the original market rates at the time of initial recognition? Answer is no. You will be taking it based on the market rates on the date of early redemption, because that is what you would be foregoing if you had to opt for the early redemption. And you will have to take equity component as the balancing figure. The difference between the GL balance, which is basically the amortization table balance in case of liability component, and the new value which you have determined on the date of early redemption, for the liability component it will go to the profit and loss, and for the equity component the same will go to retained earnings. Okay, so this was where we had ended last. Did you understand, or do you have any doubts or difficulties or query or whatever it is? Yes. I had given you one question to do towards the end of yesterday. Did anybody try it out? Could you do it, or do you want me to do it? Yes. Good morning, Viraj. Where are the others? Yes. Did you understand yesterday's session, everyone? Have you tried that RTP May 2022 question, May 2018 question, which I had told you to do? Question number 2. I had closed yesterday's session with this homework. Did you guys try this out? Yes. Bolo, anybody who has not tried it? Viraj, did you try this question? Okay, good morning. Hi, Janvi. Yes. So you could try this out. Did you get the answer? Yes. Others, whoever have tried it, did you get the answer? Yes. You need me to solve it, or shall we proceed to the next topic of discussion? Yes. Not many people have still woken up. Okay. Yes, no answers. Shall we solve, or do we proceed further? Okay, 188 is all right. That's on account of rounding off. Okay. So that 188 ka jo difference hai, you can, kind of ignore that. Okay. Good morning, Tushar. Okay. All right. Nobody is responding because I think many are yet to join. So what we will do is we will quickly solve this one question, and then we shall proceed further. Okay. So let us read the question. On 1st April X4, Shelter issued 5,000 8% convertible debentures with a face value of rupees 100. So 5,000 into 100, that means the issue proceeds or issue price, what you get is 5,000 into 100, 5 lakhs. That is the face value. Okay. All right. The debentures are convertible into equity shares at a conversion price of 105 per share. Interest is payable annually in cash. At the date of issue, Shelter could have issued non-convertible debt with a 5-year term bearing a coupon interest rate of 12%. Okay, so this is the data for initial recognition. Okay, so let us proceed to do the split accounting. So initial recognition. This is question 2. RTP May 2022. So initial recognition. Okay. So liability component is equal to 5,000 bonds, na? Yes, debentures, sorry. 5,000 debentures of face value 100 each with payment of 8% coupon multiplied by present value annuity factor 12% for a period of 5 years, if I am not wrong. Yes, maturing 20x9. Okay, so this comes to 5 years. Okay, plus the principal. Okay, all right. So 5,000 debentures into rupees 100 into present value factor 12% 5th year. Okay, so this is what should be your calculations. All right. Now there are many who ask, sir, we are having a value of 100 each. The debentures are convertible into shares at a conversion price of 105 per share. So we should be taking this as 105. Why did you take this as 100? This could be a common query that you will be having. Yes, see, we are calculating what? We are calculating the liability component. And because we are calculating the liability component, we have to look at the redemption value and not at the conversion value. Okay, so if you have taken 105, that would be incorrect because that would amount to the conversion value, which is not relevant for the purpose of liability component determination. Okay, so if I take the present value factors and plug in the values, I will be getting a 3.605 as the annuity factor and I will be getting 0.567. Okay, if you have taken 2 decimals, 3 decimals, wo jo bhi hai, answer is going to get modified accordingly. Okay. All right. So this gives us how much? This gives us how much? 5,100 into 0.08 into 3.605. 144,200 plus 5 lakhs 0.567. So this comes to 4,27,700. 4,27,700. Okay. All right. That's absolutely right. Okay. Okay. All right. So now let us move on to the next one. Therefore, equity component. Therefore, equity component is equal to 5,000 into 100. All right, 5 lakhs. $72,300. Okay, so this is what is the initial recognition. This is what is the initial recognition. Show accounting entries. So my journal entry is going to be at the time of initial recognition. I will pass the entry. $5 lakhs. Okay, so this is what is the entry you will pass at the time of initial recognition. All right. Okay, now the question that comes in here, is, and a very logical one at that. See, you have issued convertible debentures. Okay. Now in the question entirely, nowhere is it written that it is a optionally convertible debenture. Okay, if you look at the question, nowhere it is written that it is an optionally convertible debentures. So therefore, we are going to immediately jump up and say that no, this is a compulsorily convertible debenture, and accordingly we should do the accounting. If it were a compulsorily convertible debenture, the problem would be that the principal would not be considered into the redemption, into the liability component calculations, and because of that हम लोग क्या करते थे, we would just take the stream of interest as the liability component and the equity component would be a high value. Now here we have considered the principal, though specifically it is not written anywhere that it is an optionally convertible debenture. It is an optionally convertible debenture. Okay. Now understand carefully what is happening in this question. Sir, in this question, there is a tender offer. There is a tender offer to convertible to debenture holders to repurchase the debentures for 5,25,000. That means what? There is an option of early redemption that is being given. There is an offer for early redemption that is being given, which means these debentures can be redeemed also. See, when is early redemption possible? When redemption is possible in the first place. Are you able to follow? See, when is early redemption possible? Early redemption is possible when actual redemption option exists. Because there is a redemption offer, we are going ahead and doing an early redemption. Agar redemption hota hi nahi, then how would I do an early redemption? If the instrument did not contain a redemption offer, I cannot do an early redemption because these are compulsorily convertible instruments. And therefore, the presumption is that these debentures are redeemable as well. These debentures are redeemable as well. Okay. And that is a very logical and justifiable assumption that we have given, because if an instrument needs to be early redeemed, it should be redeemable in the first place. But sir, these are convertible. Yes, that is why I'm telling that both the options exist. It could either be converted or it could either be redeemed. So first point is that it is having both the features. Conversion also is possible. Redemption also is possible. The next aspect is you can see that the holders have accepted. You can see that the holders have accepted. That means the option lies with the holders. That means the option lies with the holders. And more often than not, it makes sense also that these options lie with the holders. It makes sense that these options lie with the holders. So therefore, on a very sound principle, we are concluding that these convertibles are optionally convertible at the option of the debenture holders. At the option of the debenture holders. Are you clear with this? Yes. Are you clear with this? Those of you who thought about it, very good. Those of you who did not think about it and got the answer right, you are lucky. But nevertheless, it's nice. Okay. So we just write a small paragraph for this. Okay, so that, when you are revising, you will understand what needs to be done, what needs to be taken into consideration. Okay, so now we'll just write a couple of points. These points need not be written in the exam hall. Okay, these points are for your reference only. Okay, important points. First one. In the absence of any information, comma, the conversion is assumed to be compulsory. However, in early redemption questions, it is rightly assumed in ICAI solutions as well. It is rightly assumed that the instruments are optionally convertible at holder's option. This is based on the reasoning that for an instrument to be early redeemed, comma, such instrument needs to be redeemable in the first place. Okay, so this is a very sound presumption that we are making, and that is why we have considered that such instrument needs to be redeemable in the first place. Compulsorily convertible instrument does not have redemption features and hence unlikely to be early redeemed. Okay, so this is the first point that you will have to take into consideration. Okay, Second one, there is that conversion price which is there. So we'll just write a point so that you can avoid any confusions in the future. Redemption price and conversion price are two different concepts, and hence cannot be assumed to be the same. If the question does not give any information about redemption price, it would be assumed that the redemption would happen at par and not at conversion price. Okay, so these are two things which we have based our solutions on. Both of them make sense. Okay, the institute has done it right. Okay, so both make sense. So you can just take a note of this. Okay. All right. So Kaushiki's query is done. Namrata, good morning. Yes. Shubham, good morning. Yes. All right. Okay. Shall we proceed further? Have you noted down everyone? Yes. Okay. So let us proceed. We have done the initial recognition part, and then we will proceed to early redemption. Okay. So on 1st April X7, the convertibles have a fair value of 5,25,000. So therefore makes a tender offer to repurchase at the fair value of 5,25,000, which is accepted. So what I will have to do now, I will now have to do the split of 5,25,000. Based on what? Based on the market rates prevailing as on the date of early redemption. So that data is given here for you. At the date of repurchase, Shelter could have issued non-convertible debt with a 2-year term bearing interest at 9%. So this is the basis for which we will do our next set of split accounting. Okay. So now early redemption. Early redemption. Okay. Liability component is equal to, you are paying interest 40,000 into PVAF. Which one are you going to consider? Sir, will I consider 12? Will I consider 9? कौन सा आप consider करोगे? Sir, we will consider how much? 9%. Yes. So into, students can have a tendency to go wrong here. So 9%, comma, 2 years. Plus, you are going to get the principal also back. 5 lakhs into present value factor 9% second year. So what is the PVF? This is going to be 9%, right? So these two. Plus okay. Four lakh 91,360. Okay. We will make the amortization table. We will make the amortization table. वो करना ही पड़ेगा ना, otherwise we cannot do that. Okay. You can do it any point of time, immediately after initial recognition or as a part of early redemption. Okay. Any time you can do that. Equity component 5,25,000 minus 491,360. So this is 33,640. Okay. Now we prepare original amortization table. Determination of balances as on 1st April X7. Okay, so this will be amortization table. Year 4 में दिया था, तो 5, 6, 7. We have to prepare the table for 3 years. Opening 4,27,700. Effective interest rate is 12% initially. Coupon is 40,000. Closing. So 4,27,700 0.12 51,324 40,000. $439,024. $52,683. 40,000. $451,707. 54,205. 4 lakh 65,912. Equity component balance. Will this be remeasured? Answer is no. Will continue to remain at rupees 72,300 on 1420x7. On 1420x7. Are we clear about this? Yes. Are we clear about this? So now let us proceed with the journal entries. for early redemption. Okay. So now liability component debit 4 lakh. This liability is ultimately getting settled by paying how much? By paying 4,91,360 for the liability component. Okay. To bank account 4,91,360. So what is the balancing figure? This is loss on early redemption, which goes to the P&L, which goes to the P&L. On the other side, you will be having equity component debit 72,300 to bank. How much are you paying off? 33,640. So the difference comes to how much? 38,660. To retained earnings, gain on settlement. Are we clear about this? Yes. Equity component balancing figure goes to retained earnings, whereas liability component balancing figure goes to the P&L. Are we clear? Yes. Anybody has any doubts so far? Anybody has any doubts? Kaushiki, is it clear? Janvi to had got it in any case. Namrata, is it clear? Viraj Desai, is it clear? Shubham, is it clear? All right. So that takes care of question number 2 from the RTP. Okay. So let us then proceed further. Irredeemable instruments. Irredeemable instruments. Example, perpetual bonds. Example, perpetual bonds. Acha, in India, you don't see this because normally our preference shares are also mandatorily redeemable after 20 years. Okay, so you don't really see this. So therefore, if I talk about my irredeemable instruments, what do these features, what do you mean by irredeemable instruments? It means that you don't have an obligation to deliver cash. No, no, no. For a small 188 difference, the paper checker cannot deduct the marks. Okay. Cannot. Okay. This is my humble opinion because we have taken this. If you can see in the solution, what we have done is we have taken their own rates. Okay. So where is that 188 difference you are getting? Let me just see it quickly. Okay. This we got 427,700. So this is right. So we got this right. This entry is correct. Now this entry is also correct. Okay, 5,25,000. Okay, so this is right. Now see, acha, I got it what they did. Okay, fine. This is okay. All right. Now, where the things stand, see, I'll tell you. Interesting. The whole issue arises here. 4,66,100. Okay. Now, see, there are two ways of calculating this 4,66,000 of the liability component. Okay. दो तरीके हैं. What we have done also is correct. What they have done also is correct. तो difference क्यों है? It's just that, see, this is the life of the bond. Suppose करो, this is the life of the bond. Okay. सीधा नहीं है ये. Okay. Suppose this is the 5-year life of the bond. Issue, redemption. And somewhere in between, you have opted for early redemption. So this is 3 years. This is 2 years. So what these people, what this institute has done, what we have done is, we started from issue date and then we proceeded in this direction to arrive at the general ledger balance, to arrive at the liability component balance at the beginning of the 3rd year. Okay, which is correct. What they have done is, what institute has done is, they have picked up this and then deducted the cash flows which are not realized. So that meets at this particular stage. Okay. So it is either you move from front and go forward, or you start backward, Okay. So the unrealized cash flow is going to be 2 years. Yes, is going to be 2 years. So now the question is, how do I determine that? How do I determine that? All right. So if you look at the question, 1 second. What is the discount rates which are given? Just a second. Okay. Okay. So what they have done is, they have taken the remaining cash flows. They have taken the remaining cash flows to be realized as the present value. So what they have done is, as on this date, I am yet to recover 40,000 into present value annuity factor for 12% 2 years. So this comes to 1.69 plus you are having recovery of principal at the end of 2nd year, So if you do this, you will get 4,66,100. Acha, which is more correct? ऐसा कुछ भी नहीं है. Okay, the first method also is correct, what we did. The second method also is correct, what we have, what is done by the institute. The difference of 188 is only due to rounding off. You can ignore that. Okay. Why we will prefer the first method? We have been doing that continuously. Okay. The chance of not making a mistake is very high if you take the first approach. If you take this approach, there could be a case where you fumble with the years left, where you could fumble with the discounting rates. Okay. तो वो सब अपने को चाहिए ही नहीं. वो सब अपने को चाहिए नहीं. We don't want all of that. Okay, we want to proceed in a normal manner, in a straight manner. Okay, so that is how you will be considering. That is how you will be considering the answer. Okay, so that takes care of your difference. Yes, that takes care of your difference. All right. Okay. In the PVF of 9%, will you take year 1 and year 2, or will we take year 4 and year 5? You tell me what we will take. Okay, you tell me what are we going to take. Okay, see, we are sitting on the beginning of the third year, and we are going to lose the next couple of months interest. Yes or no? The couple of years interest. So how can you take year 4 and year 5 when you are sitting on the third year? You are losing the interest for year 4 and year 5, which is basically year 1 and year 2 from year number 3. So therefore, you will be taking years 1 and 2 as the discounting rates. Am I correct? Yes. Are you clear with that? Yes. Bolo yaar. Yes or no? Yes. You will be taking year 1 and 2 because you are on the beginning of third year. So year 4 means within 1 year. Okay. So 1 year from year 3, and fifth year is 2 years from year 3. So you will take year 1 and 2. Okay. We can do the method done in class, Janvi. We can do the method. Okay. Nothing is wrong in that. 188, 100, 200, all these are on account of rounding off. What I would suggest you is ignore the rounding off. एक Excel sheet open करो. Not right now, but for your own academic interest. Okay. Do it on Excel. Take the entire rounding, the entire discounting figures, and do the calculation. Exactly pi to pi it is going to match at the end of year 3 based on the method which we did, or based on the method which the institute has followed. Both are absolutely correct. Okay, nothing is wrong, but I would prefer to do what we have done. Okay, thoda lamba hai, it's a little longer, but I think it is the safest one. Okay, all right. So coming back to our discussion, irredeemable instruments. Okay, irredeemable instruments. Example, perpetual bonds. So here the feature is that these bonds only pay out interest. These bonds only pay out interest. These bonds only pay out the contractual cash flow, which is a stream of cash flows. The perpetuity cash flow, the maturity cash flow, the principal cash flow is never repaid. Okay, the nature is perpetual. Sir, these instruments will not find it in India. Why? Because in India, the Companies Act mandates that preference shares have to be redeemed within 20 years at the max. Okay. By the by, these instruments are not convertible. Okay. Means at the end of the tenure, these instruments will not be converted into equity shares. Basically, these instruments don't have a life only. Okay. These instruments don't have a life. They continue till the company exists. So company is a going concern. These instruments are also going concern. Are you able to follow? So these instruments don't come with a defined life like a 10-year debenture, 20-year debenture, etc., etc. They are perpetual. इसका कोई time limit नहीं है, समय के हिसाब से नहीं चलते. But there is no obligation to deliver cash for the principal amount. You have obligation to deliver cash only for the interest. So you tell me, the principal, does it exhibit equity feature? Answer is yes. Why? Because there is no obligation to deliver cash. If you had an obligation to deliver cash, it becomes a financial liability. But here there is no obligation to deliver cash, and that is why the principal amount is going to be categorized as equity. Are we able to follow this? अपने को समझ में आता है ये? Yes. Bolo. All right. Now the issue is cash flow. The issue is cash flow. See, I have to determine present value of future cash flows, yes or no? So when I have to use present value of future cash flows, the cash flow is constant. There is no growth only in the cash flow. There is no growth only in the cash flow. So normally, if I have to value a security, I use Gordon's formula. Okay, I use Gordon's formula where the dividend discount model is what it is commonly known for equity share. P0 equals D1 upon KE minus G. So this is typically for an equity share. This is typically for an equity share where D1 stands for interest to be paid in the next year divided by KE, that is the equity, that is the cost of equity, minus G, which is the expected growth in the coming year. Okay. If I extend it to the bond, price of the bond is going to be interest at the end of the first year divided by KD, that is cost of debt, minus G. Now, in this case, G to kuch hai hi nahi. Yes, G is 0 because it is interest. Interest to grow hoga nahi. It is just a coupon interest, a fixed value. So therefore, koi growth nahi hoga. G is going to be 0. G is going to be 0. So this becomes I1 upon KD. I1 upon KD. Okay. And this is how you will do the valuation. So let us take a case where there is a bond of rupees 10,000. A bond of rupees 10,000 with interest at the rate of 8%. With interest at the rate of 8%. So this comes to how much? Rupees 800 per annum. Am I right? 10,000 into 8%, 800 ही होता है ना? Yes. That's right. Rupees 800 per annum. Therefore, price of the bond is equal to rupees 800 divided by 10%. So this is equal to rupees 8,000. This is equal to rupees 8,000. But the investor has paid how much? The investor has paid 10,000. The value of the bond is 8,000. Investor has paid 10,000. So 2,000 represents the equity feature. So bank account debit 10,000 to liability component 8,000 to equity component 2,000. Equity component as usual is never going to change. Okay, it will remain at 2,000. And suppose this instrument, the perpetuity, an instrument without a perpetuity feature has a market rate of 10%. Okay, that is how I have taken this. Okay, that is how we have taken this 10%. Okay, this is the market rate. Okay, so you will be doing it this way. So market rate of an instrument without a perpetuity feature is 10%. You are paying a coupon of 8%. Okay, so now if I have to prepare an amortization table, it looks something like this. Year opening, effective interest rate at 10%, coupon, closing. So year 1, opening starts with 8,000. EIR is 10%, 800. Yes. And coupon is 800. So closing is 8,000. And this goes on flowing like this. This goes on flowing like this. वो कभी खत्म ही नहीं होगा. 10% is the market rate which is assumed for an instrument which is not in perpetuity. Okay, which is not in perpetuity. So that becomes my EIR. Okay. So 8,000 opening, 8,000 closing. Every year this is going to be the story. तो इसको हम लोग बोलते हैं an instrument in perpetuity or an irredeemable instrument. So there is no concept of redemption. There is no concept of redemption or conversion. वो बस है. That instrument is there. Okay. So that is how you will be doing the questions. That is how you will be doing the question. Are we clear about irredeemable debenture? A small concept, ज़्यादा आएगा नहीं. Okay. But nevertheless, वो है तो करना पड़ेगा. Are we to pick up an RTP? Which RTP question? May 22. Just a second. Do I have it here? No. Right. Okay. So here, one second. Question. RTP. Before that, page. Just a second. The chapters are huge. Yes. Okay. Fine. We quickly do this one small question. Chota sa question hai. Yes. And then we shall proceed. Illustration 30. This one. Perpetual loan with mandatory interest. P Limited takes a loan from Q Limited for 12 lakhs. The loan is perpetual, entitles the holder to fixed interest of 8% per annum. Rate of interest commensurate with credit risk profile is 12%. Calculate the value of the liability as well as the equity components. So how much are you going to do that payment? 12 lakhs into 8%, 96,000. 12 lakhs into 8%, 96,000 divided by rate of interest 12%. So 96,000 by 12% is 8 lakhs. This is the value of the liability component. So equity component will be 12 minus 8, 4 lakhs. 12 minus 8, 4 lakhs. Are we clear with this? Yes. Are we clear with this? Yes. तो एक छोटा सा question था. That's about it. Anybody has any doubt so far? Clear? Okay, fine. So that you can just have it as one of the many concepts which we are going to cover. Okay. No. Okay. Let us now come to RTP May 2022 question number 14. Okay. All right. ABC Limited issues. Are you able to see the question? Yes. ABC Limited issues 4% 1 lakh OCPS. You know what is OCPS? Optionally convertible preference shares. Optionally convertible preference shares. At a face value of rupees 100 per share on 1st April 20x1. And these are redeemable after 5 years. That is on 31st March 20x6. Dividend is non-cumulative. Okay. Each preference share entitles the holders to 10 equity shares. Okay. And the preference shares are optionally convertible by the holder at any time until maturity. How will the preference shares be classified at initial recognition, assuming that a comparable instrument carries a market interest rate of 7%? Provide journal entries for year 1. Will the classification change subsequently in case there is a likelihood that OCPS will be encashed at the end of the maturity period? Okay, so will the classification be changed? Likelihood that OCPS is going to be encashed. So this is what is your question. Okay. All right, fine. Tell me, what is the nature of the cash flow? What is the nature of the cash flow? Is it optionally convertible or compulsorily convertible? Is it optionally convertible or compulsorily convertible? बोलो यार. And also tell me, is the dividend mandatory or is the dividend discretionary? Is the dividend mandatory or is the dividend discretionary? See, each preference share entitles holders to 10 equity shares and they are optionally convertible by the holder. Optionally convertible by the holder. Okay. So optionally convertible. What about dividends? Non-cumulative. What do you mean by non-cumulative? That means jab man kare de do. Yes, when you want, you do it. Okay. So therefore, is there an obligation to deliver cash for the dividend? Answer is no. Because it is non-cumulative. Means this year if you don't give it is fine. Next year give only next year's dividend. 3 saal dividend mat do. In the 4th year, you pay only the 4th year's dividend. The first 3 years you had not declared, that has not accumulated. So these are discretionary dividends. These are discretionary dividends. But if you look at the principal amount, each preference shares entitles the holders to 10 equity shares and they are optionally convertible. Optionally. Is it mandatorily convertible? Answer is no. Optionally है मतलब कल को the holder उठ के आपसे cash मांग सकता है. Can the holder demand cash from you for the principal amount? Answer is yes. Yes. So therefore, is there a liability sitting on our head? Absolutely. There is a liability for the principal amount that is sitting on your head. And that is why we have to recognize a liability. It cannot be a pure equity. It cannot be a pure equity. Are we clear with this? Yes. Have we understood this? So dividend has an equity feature. Principal has a liability feature because it is optionally convertible. It is optionally convertible. So you will need to record the liability. Okay. So therefore, this is question 14. RTP May 22. Okay. So now let us stream of cash flows. Dividend, principal. So here the dividend is non-cumulative. That is discretionary. Therefore, no obligation to deliver cash. No obligation to deliver cash. And because there is no obligation to deliver cash, because there is no obligation to deliver cash, what is this instrument going to become? This stream is going to become equity. This is equity. Coming to the principal. Optionally convertible. Whose option? Holder's option. Holder's option. And that is why this becomes a financial liability feature with option to convert to fixed number of own equity instruments. Therefore, compound financial instrument. Therefore, it becomes a compound financial instrument. Are we clear with this? Okay. Don't write this here if you are noting it down. Therefore, compound financial instrument. So my liability component is what I will value first, is equal to, उठ के कभी भी कुछ भी मांग सकते हैं. So 4%, 1 crore optionally convertible preference shares at a face value, 1 lakh optionally convertible preference shares at a face value of rupees 100. So that is rupees 1 crore into present value factor. कितना मिलेगा? After 5 years at the rate of 7%. 5th year. So how much does this come to? 1, 2, 3, 4, 5. 0.7130. 71,30,000. 71,30,000. So year 0, bank account debit, ₹1 crore. Liability component, 71,30,000. Equity component, 28,70,000. 28,70,000. Are we clear with this? Yes. Yes. What is the question asked? Provide journal entries for year 1. So year 0, I record it. That means year 1 opening. So end of year 1, interest is going to come. So I will be having finance cost, P&L debit, to liability component. 71,30,000 into how much? 7%. ₹4,99,100. 4,99,100. All clear? Yes. Okay. So now suppose dividend is paid. See, dividend is discretionary. I made good profits. I think I should pay off the dividend. So that is what the company thinks. So therefore, the company goes ahead and issues dividend. You tell me what will be the entry for dividend. You tell me what will be the entry for dividend. Okay. What will be the entry for dividend? आप बताओ. What is the rate? 4% into 1 crore. So that is 40,000 is the dividend. You tell me, if I decide to pay 4% dividend. Sorry, 4 lakhs. 4 lakhs. Tell me, what will be the entry for dividend paid of 4 lakhs? Suppose company उठ के बोलता है नहीं, I want to pay a dividend of 4 lakhs. What entry are you going to pass? What entry are you going to pass? Reduced from equity. But if I reduce from equity, it becomes a buyback. Yes or no? अगर मैंने equity debit कर दिया, if I debit equity, my equity is reducing ना. Already I have an equity component sitting here. I have an equity component. If I debit the equity again, it ends up becoming a buyback, whereas this is not a buyback. ये buyback थोड़ी ही है. This is just a dividend declaration that is going on. So you tell me, I cannot debit equity component, okay? Because of the obvious reason कि वो buyback नहीं है. So equity component कम नहीं हो रहा है. It is my happiness or the company's performance that has enabled me to declare the dividend. So आप बताओ, what are you going to debit? What are you going to debit? Agreed. How can I do 28,70,000 को मैं डेबिट कैसे कर सकता हूं? फर्स्ट पॉइंट. सेकेंड पॉइंट, सी 4 lakhs. मैंने 7 साल पे कर दिया 28 lakhs. In the 8th year, will there be a balance in the equity component? नहीं रहेगा सर. So how am I reducing this? See, this equity component cannot be remeasured, changed, altered, whatever it is, because I cannot modify this. Okay. So ये 28,70,000 cannot be touched at all because it's not a buyback. Equities can be touched only when there is a buyback. Okay, so यहाँ पे तो there is no buyback happening. Yes, you are just declaring dividend. So what am I going to debit? What am I going to debit? Are you able to follow? Yes, you are very close to the answer, but I want you to think a little bit more. Okay. All right. What about others? Viraj, Kaushiki, Tushar, Garg, Shubham, what do you guys think? Yes, that's right. Okay, what about the others? क्या डेबिट करोगे? Can I debit profit and loss account? Answer is no. It's not my finance cost. Can I debit liability component? Answer is no, because it's not classified as a financial liability. It is an equity. Can I debit equity component? Answer to that also is no, because it is not a buyback. तो बचा कौन सा? Reserves. So you debit retained earnings. You debit retained earnings. That's the only way you can do this. There is no other option which is possible. Why I cannot debit liability? Because ये liability नहीं है. I don't have the obligation to deliver cash. Okay. Second one is, what I cannot debit? I cannot debit equity component because it is not a buyback. Can I debit profit and loss? Answer is no, because it is not a finance cost. So the last option which is left is, can I debit retained earnings? Answer is yes. अपार्ट फ्रॉम दैट और कुछ है ही नहीं डेबिट करने के लिए. इज इट ओके? यस, डिड यू अंडरस्टैंड गाइस? ओके. All right. So this takes care of that part. You want to write this or you can remember this? This is not there as a part of the question, but can you remember this? Or you want me to give you something in writing? But a stupid सा question है. Are you able to remember this? Yes. Okay, we write it down. In case the company declares dividend in any year, comma, it would be treated as payment towards equity and hence would be adjusted directly against other equity, not other equity, retained earnings. Or when I say other equity, not equity component, just give me a minute, of instrument. That remains as it is. Okay. Just give me a minute. Somebody at the door. Okay. So that it would be adjusted directly against retained earnings or other equity. Liability slash P&L will not be impacted. Liability slash P&L will not be impacted. Okay. All right. Acha. Then what they have asked? Will the classification change subsequently in case there is a likelihood that OCPS will be encashed at the end of the maturity period? Will the classification change subsequently? Answer is no. Classification is not going to change because we already have a liability component. We already have a liability component, so that is not going to change in any case. Yes, if it is redeemed, liability component will be debited and bank will be credited, and whatever is the balance in the equity component, which is 28,70,000, that will be transferred to retained earnings. That's it. Nothing else is going to be done. Okay, so that takes care of this part. Yes, there is one question of RTP which I will do it along with other additional questions. वो थोड़ा सा अलग है, but broadly, are you comfortable with compound financial instruments? Yes. Are you comfortable now? Are you getting some familiarity with the concept? That is what I'm more interested in. Okay. And are you feeling a little confident about being able to attempt these questions? Yes. At the same time, are you confident about the definition of financial assets, definition of financial liabilities? Yes. Are you confident about off-market transactions? Yes. In off-market transactions, I only have one concept which is left, that is prepayment of a loan or advance, which is at off-market transaction. Okay. I give a loan to employee at concessional rate of interest and he prepays the loan. So that is one concept which we have not done. I'll be doing it as a part of the problems. Okay. All right. So that takes care of this part. Now, couple of another small pointers. One is there could be a case where your interest rate is not fixed. Okay. You know, this is very common in case of entities. Okay. Banks do not give a fixed rate of interest because it may be very adverse to the bank also. So what the bank will generally do is the bank is going to take it as a variable rate. It could be benchmarked against the MCLR or the RBI bank rate or the London interbank offer rate. Okay. All right. Of course, you cannot have the equity component. You know, see, once the instrument is paid, that equity component is not going to remain, right? You cannot have that equity component continuing because otherwise there will be a problem. There will be a problem. If I continue with that equity component, the reader will feel equity component of financial instrument, or you will say equity component of debenture or equity component of financial instrument. Then the reader will scout and look, अरे किधर है equity where is the financial instrument? वो तो आपने पे कर चुका है. So therefore वो तो है ही नहीं हमारे बुक्स में. So therefore I cannot keep equity component. उसको तो मुझे ट्रांसफर करना पड़ेगा retained earnings में. Okay. So therefore it will go to retained earnings. Okay. All right. So coming to the next part, floating rate interests are possible. It is against the marginal lending rate. Okay. Plus a particular spread. So if you go to take home loans right now, it will be like MCLR plus 1%. If you opt for a cash credit, it could be MCLR plus 2.5% or RBI rate plus a particular amount. So the interest rates keep on varying. Now, when we did financial instruments and the splitting of the liability component, till now, the interest rate was constant. Till now, the interest rate was constant. 7%, 12%, 10%, etc., etc. Okay. But now in this case, what is happening is interest rates vary. So over the tenure of the bond, वो कभी भी कुछ भी हो सकता है. You have a bond of 10 years. RBI rate will definitely vary over 10 years. So, sir, हम predict करें क्या? No. Prediction is not permitted in accounting because it leads to a very high bias. It leads to a very high bias. So you are not permitted to go ahead with what you say, you are not permitted to go ahead with predictions. What you have to do is you will have to determine the component, the liability component, based on the rate which exists on the initial date of recognition. Bas, that's it. You will have to take it based on the date of initial recognition. Don't predict anything. The coupon rate will be the RBI rate on initial recognition. The market rate also is going to be the RBI rate on initial recognition. There is not going to be any prediction of the rate movements in the future, because that will not be correct. That is not going to be correct. In fact, a similar concept is also there in Ind AS 116. As far as I remember, payments which are linked to an index, lease payments linked to an index, and the index is a movable index. It keeps on moving, like inflation index or gold price index, etc. So therefore, in that also, the standard expressly prohibits that you cannot estimate the movement of the indices in the future. You take a particular index rate that is there as on a particular date and do the calculation. And when the indices change subsequently, that time you will modify the lease workings. So here also, we are not talking about modification, because this is initial recognition. Initial recognition is always going to be at the rate which existed on the date of initial recognition. Are we able to understand this? Yes, are we able to follow? Any doubts? तो वो छोटा सा point था. There is nothing special or major about that. So let us then move on to the next one. That is callable instruments or puttable instruments. Okay. We are still in liabilities only. This is an option which is there. A callable as well as puttable instruments. Okay. So let us now focus on this. Callable instruments. Callable instruments and puttable instruments. Basically, these are instruments that come with a call option or with a put option. Okay. So now, what do you mean by callable instruments? Callable means somebody should have the right to call back the instruments. Okay, call back. So who will have a callable instrument right? See, the issuer gives the instrument to the holder. So who has a right to call? Holder call nahi kar sakta na. Holder is already holding. Khud se kaise call karega? So the issuer can call back the instrument. Call will always mean buy. There is an instrument there, you are calling it towards yourself. Puttable is always sell. Puttable will always mean sell, because you have the instrument with you, you are putting it for sale. So puttable means sell. Callable means to call back the instrument towards yourself. So when I talk about callable, based on this reasoning, who will be having the callable instrument rights? So this right is there with the issuer. Issuer has right to call the instrument. Sir, kabhi bhi kar sakta hai? Yes, any point of time before maturity. Before maturity. Issuer has right to call the instruments before maturity. So when the callback happens, the holder has to give the instrument back to the issuer. Okay, the holder has to give the instrument back to the issuer. He will be compensated for it. Okay, वो जो भी redemption amount है उसको मिल जाएगा. Okay, so that is not going to be a problem. Okay, so now you tell me, if the issuer has a right to call the instrument, then is this option favorable to the issuer or is it favorable to the holder? Is it favorable to the issuer or is it favorable to the holder? Bolo, tell me. It is obviously favorable to the issuer. Sir, why do you say so? See, suppose in the market, you have issued an instrument which is having 10% rate of interest. The market is having, let us say, a 7% rate of interest. So what can the issuer do? He can raise a fresh liability at 7%, call back the 10% loan and pay it off with the 7%. In effect, what has he done? Interest rate from 10%, he has brought it down to 7%. So this is always going to be favorable to the issuer. This is always going to be favorable to the issuer. And if it is favorable to the issuer, this will be adverse to the holder. Why adverse to the holder? The holder was getting 10% rate of interest till now. Now, by virtue of this, the holder will get, say, a lower rate of interest, because then the holder will invest in the market where the rate of interest has dropped down to 7%. So, isko hum log bolte hain callable instrument. We call this as a callable instrument. Okay. All right. Now, let us take the case of puttable instruments. Opposite khelenge. In callable, issuer has the right. So in puttable, who will have the right? Holder. Holder can put the instrument, and issuer has to return the money or repay the issuer for the same. Okay, holder can put the instrument. Okay. Example, a mutual fund, which is an open-ended mutual fund. Yes. What is mutual fund? We are holding units in mutual funds. Apne ko jab bechna hai, what do? We have the instrument with us. We go to the mutual fund asset management company, and then we say, I'm putting these instruments to you. Please sell it to us. So we make a claim for redemption, and they are obligated to pay us back. So open-ended mutual fund is an example of a puttable instrument. Okay. Now this will be favorable to whom? Sir, this will be favorable to the holder and adverse to the issuer. Adverse to the issuer. Okay. Now, if I take the things a step forward, you tell me, suppose I have a plain vanilla instrument. Plain vanilla instrument matlab ye sab na exotic toppings. Option nahi hai, puttable thing nahi hai, callable nahi hai, kuch nahi. Seedha saadha plain instrument. Okay. Like you have in your phones, there is something known as stock Android. Okay. So there is no interface of the company. So you have a company like Vivo, which comes out with its own interface. You have a company like Samsung, which brings its own interface, modifies the Android operating system so that they bring in their own features. That is known as an exotic instrument. But the Google Pixel phones that come out, they come out with stock Android, the base version. Some people like stock Android. Okay. So therefore, let us now look at a case where there is a plain vanilla instrument, okay, with no exotic features, plain vanilla instrument. So I have market rate of interest of non-callable, non-puttable, plain vanilla instrument is 10%. Value is rupees 1000. You tell me, okay, now fair value of call option is 50. This will be given in the question to you. You don't have to break your head. So fair value of call option is rupees 50. Therefore, fair value of callable instrument, how much is it going to be? Sir, it will remain at 1000, first option. It will go to 1050, second option, or it will go to 950, third option. What is it going to be? I have a plain vanilla instrument. There is no callable, puttable, kuch bhi nahi hai. It's a plain vanilla instrument. To that instrument, we are going to, there is a call option on that instrument. That means the holder can, the issuer can call back the instrument at any time. So the call option is favorable to the issuer and adverse to the holder. So now the fair value of that call option is 50. So now if I have to determine the fair value of the callable instrument, what is it going to be? Will it be 1000? बोलेंगे कोई फर्क नहीं पड़ता सर, वो तो ऑप्शन है, वो अलग है. We are now combining the features. So 1000 तो कतई नहीं हो सकता. It cannot be 1000 under any circumstances, because now my plain vanilla instrument has a call option attached to it. Okay. So 1000 तो नहीं होगा. Will it be 1050? Well, it is adverse to the issuer. So the issuer will say, you are taking a feature that is benefiting you. So why should I pay you a higher amount when it is adverse to me? So therefore, it is not going to be 1050 also. So it is going to be 950. It is going to be 950. So what will be the impact of this? The impact is when I determine the liability component at initial recognition, that is a plain vanilla liability component. If it has a callable feature attached to that, if there is a callable feature attached, what are you going to do? You will reduce that callable feature from the liability value. You will reduce it from the liability value. Will I be given the fair value of the call option? Answer is yes. So that case, you will reduce the value of the liability option. Is it okay? Yes. Are we clear with that? Yes. If I put in the same example here, okay, the same example, I extrapolate it to a put option. Now you tell me what will be the value? Will it be 1000, 1050 or 950? Put option has a value of 50. The plain vanilla instrument has a value of 1000. So now you tell me what is it going to be, the value of a puttable instrument? Will it be 1000? Will it be 1050 or will it be 950? What could it be? It cannot be 1000 for certain, because 1000 is a plain vanilla instrument without a puttable or callable option. So 1000 to nahi ho sakta. I am adding something. So it cannot be 950, because the company will say, I am giving you the right to put your instruments at any point of time. And therefore it cannot be 950. Okay. You have to pay me something extra. So therefore the value is going to be 1050. The value is going to be 1050. So the sum total of this discussion is that in the question, when you are given callable or puttable instruments, आप क्या करोगे? Step 1, do initial split as it is. taking the market rate of interest of a plain vanilla instrument, which will be given in the question. And you will additionally be given the value of the call option or the put option. So in the case of a call option, academically, deduct value of callable fee of call option. Call option, it's a feature, okay? And here, add value of put option. Add value of put option. Are we clear with this? Yes, अपने को समझ में आता है? Yes. Are you clear? Yes. Any doubts? Viraj, did you follow? Tushar, did you follow? Yes. Viraj, Tushar, are we able to understand? Yes or no? ठीक है? All right. So now let us come to one question. We shall slightly modify that, but let us, based on this understanding, we will come to solve one question on callable puttable feature, page 12.114. Okay. Now let us come to this question. 32, illustration 32, page 12.114. We will slightly modify this to include one extra component, but otherwise it's all a usual question. Okay. D Limited issues preference shares to G Limited for a consideration of 10 lakhs. Okay. Preference shares. The holder has an option. So these are optionally convertible debenture or optionally convertible preference shares to convert these into a fixed number of equity instruments anytime up to a period of 3 years. Anytime up to a period of 3 years. If the option is not exercised by the holder, the preference shares are redeemed at the end of 3 years. Okay. Option is not exercised, then it is redeemed. But he can redeem or convert, okay, at any time up to a period of 3 years. Okay. Convert up to 3 years. Otherwise, after 3 years, it will be redeemed. The preference shares carry a coupon of RBI base rate plus 1% per annum. So there is a variable interest component which is included here. The prevailing market rate for similar preference shares without the conversion feature or issuer's redemption option is RBI base rate plus 4%. So this is the market rate. ये हमारा rate है RBI plus 1%, whereas market rate for a plain vanilla feature, for a plain vanilla instrument is RBI plus 4%. On the date of contract, RBI base rate is 9% per annum. Calculate the value of liability and equity components. We'll just make a small change to this. Okay. Here I'll just be adding a couple of things. So just the put option or call option feature, we will just add a call option feature. Okay. The instrument additionally gives an option to D Limited to call back the preference shares at any time during 3 years. At any time during 3 years. the fair value of the callable option, or what we call early redemption feature. The fair value of the callable option is rupees 29,165. Okay. So now calculate the value of the liability and the equity components. Okay. So it's too simple. Okay. It's very simple to do it. Okay. So you will not have any difficulty in this. Okay. So now if I have to do that, this is illustration 32, no? Yeah. Yes, illustration 32, page 12.114. Okay, so now if I have to do this, if I now have to do this, issue price is 10 lakhs. Coupon rates. Own instrument is RBI plus 1%. So that is 9% plus 1%, 10%. Market rate, RBI plus 4%. So this comes to 13%. This comes to 13%. Okay. So own instrument has a 10% rate. Okay. Don't predict कि आने वाले 3 साल में what will be the rate fluctuations and all. We are not concerned with this. This is at the time of issue. At the time of issue. That's it. There will be a change in the amortization table that will be adjusted towards the end. Okay, that will be adjusted towards the end. Okay, so this is how we will proceed. This is how we are going to proceed. Okay, all right. So now let us proceed. Let us now proceed with the working liability component of preference shares is equal to liability component of preference share is equal to 10 lakhs consideration, carry a coupon rate of 1%. Carry a coupon rate of RBI plus 1%, that is 10% in our case. Okay, so rupees 10 lakhs into 10% into present value annuity factor 13% 3 years plus rupees 10 lakhs into present value factor 13% third year. How much does it come to? How much does it come to? How much does it come to? This will be 0.6931 and this is going to be 2.3612. Is this only going to be your value of liability or will there be something else? Will there be something else? Will there be something else? You have to take it for 3 years, no? Kaushiki, you have to take it for 3 years. I think you have taken it for 2 years. Okay, just check. Acha, tell me, is this only going to be the liability component, or will there be something else attached to it? Will there be something else that will come? Yes, 2.3612 is right. Reduce 29,165. This is important. The callable feature is making the bond unattractive to the holder. It is making it unattractive to the holder, and therefore the value of the bond will have a reduction of the fair value of the call option that is attached to it. Okay, so I will subtract 29,165. So this comes to how much? If you proceed to calculate, it will come to rupees 9,055,000. This will be 9,055,000. Therefore, equity component 10 lakh minus 9,055,000. So that comes to 99,945. So the entry will be bank account debit 10 lakhs to liability component of bond 9,55,000 to equity component of bond 99,945. Okay, so this is how we will be treating the callable features in the valuations. Okay. Yes, it's not reducing the price. It is basically shifting it from the liability component to the equity component. Okay. Are we clear with this? Yes. Have you understood? Yes. Okay. So now okay, let me see. You remember long ago we had taken up this discussion? Yes. Quite a long time ago we had taken this discussion. Okay. So here under the category of financial assets, financial liabilities, we had done examples, and then we had taken equity also. Yes, derivatives, forward contract, debentures, equity in nature. Okay. Equity ka examples we had not discussed. Okay. All right, fine. I think we had discussed financial assets, financial liabilities. Okay, fine. All right. So we had discussed equity as a contract that evidences residual interest in the assets of an entity after deducting the liabilities. Okay, so now Kaushiki is asking, the call option is not reducing the price, it is getting added in the equity component. So how is this treatment correct? Okay, all right. So how is that treatment correct? See, consider a plain instrument. A plain instrument is issued by a company. Now, if the plain instrument is issued by the company, then its value is going to come to, in this example, 9,29,220. Okay. In the same example, it is going to be 9,29,220. Okay. Now, I have a feature that is giving me, the issuer, the right to call back the option, when it is more attractive, Okay. So as an issuer, I will be at the, I will have the right to call back when the interest rates in the market are lower, Now, I will have to determine what will be the fair value of this bond of mine. See, ideally, the recognition should be at fair value. Now, if I have to determine the fair value of my liability and equity, then we can say that equity will always be a balancing figure, because otherwise I cannot independently value equity, because there is no continuous stream of cash flows that will enable me to determine the value of equity. So therefore, I have to base my valuations on the basis of the liability component of the bond. Okay. Now, the liability component of the bond had a value of 9,29,000 provided it was a plain vanilla bond. But ये plain vanilla नहीं है. Along with this bond, I have attached a callable feature. So in the market, if I go to sell this bond, will people pay me 9,29,220? Answer is no. They will not pay you 9,29,000, because they will say, "Arey, callback rights are there with you only. कल को अगर instruments, कल को market interest rates कम हो गए, if the interest rates go down, you will call back the instrument anytime. And since we are calling back the instrument at any point of time, then why should I pay you 9,29,000? I am at a risk, no? So I will not pay you 9,29,000. I will pay you lower than the fair value of that call option. So you want us to issue 10 lakhs, we give you 10 lakhs. But the fair value of the liability component jo hai, that will definitely be lower than that of the plain vanilla instrument. And that is why the liability component value is not going to be 9,29,000. It will be only 9,55,000. To the extent of the fair value of that, to the extent of the fair value of the call option, the equity component increases, because you can kind of crudely say, okay, in a very crude language, you can say that to the extent of that option value, the risk is shifted from the liability component to the equity holders, okay, to the equity holders, because now they are partly bearing a risk. They are partly bearing an additional risk that tomorrow, if interest rates go down, they will be at a loss, because the issuer can demand the money at any point of time, can demand the bond at any point of time, and inko dena hi padega. So therefore, to that extent, the equity holders' stake or risk has gone higher, and that is why we are basically shifting 29,165 from here to equity component. It's a very crude manner of saying, okay, but this is how you will treat it. Is it okay? Are we able to follow? Okay, so now let us move on to the next one. Let us now move on to the next case. We had done equity instruments, right? We had done equity instruments. Now, in equity instruments, we had discussed what? Sir, these are instruments which evidence a residual interest in the assets of the entity after deducting all its liabilities. Are you able to recollect the definition? Financial asset we discussed in detail. Financial liabilities we discussed in detail. Equity mein we saw that it is basically a contract that evidences a residual interest. A residual interest in the assets after deducting all of its liabilities. So therefore, if we have to look at examples, one will obviously be equity shares. One would obviously be equity share or equity share capital. Okay. The second one is share application money. Share application money pending allotment. Pending allotment. Okay, I'll give a break. Just we complete this and I'll give a break. Okay. Third one is contracts to be settled in own equity instruments, receive or deliver, both are included. Okay. Provided they pass the fixed for fixed test. Another example, irredeemable bonds or preference shares with discretionary interest or dividends. And then fifth case, a puttable instrument. ये तो सर पे लटकता हुआ तलवार है for a company. कभी भी they can put it and have the obligation to deliver cash. So a puttable instrument is going to be, one second. Puttable instrument is a financial liability, but puttable instrument with certain conditions. If it meets certain conditions, a puttable instrument could also be an equity. A puttable instrument could also be an equity. So we are now going to discuss what are these certain conditions. Okay, we take a break of 10 minutes. It's 9. We resume at 9:10. We take a break of 10 minutes and we discuss what are the conditions of this puttable instrument, and then that concludes our discussion so that we can then move on to derivative accounting. Maybe it will be tomorrow only. Okay, so we will do derivative accounting after that. All right. Okay, then a 10-minute break, please, and then we shall continue. Okay. All right. So let us resume. Okay. So we were discussing that certain puttable instruments would also meet the definition of equity provided certain conditions are fulfilled. Provided certain conditions are fulfilled. Ordinarily, puttable instruments meet the definition of a liability because when the holder of the instruments puts it, okay, exercises their put option, then the issuer is obligated to deliver cash. The issuer is obligated to deliver the cash, but there are couple of cases where they will be classified as equity and not financial liability, despite the fact that they become despite the fact that they require an obligation to deliver cash. Okay, so basically there are two categories of instruments. Okay, two categories of instruments and 5 conditions to be fulfilled. 5 conditions to be fulfilled. So if these two categories, if your instrument falls under any of these two categories and they fulfill the 5 conditions, then though they are puttable instruments, they will be classified as equity. They will be classified as equity. Okay. So first category is holder has the right to demand redemption at his choice. Example, units of an open-ended mutual fund scheme. Okay. Holder has the right to demand redemption. Okay. And second one, obligations arising on liquidation in case of entities having an agreed liquidation date. Example, shares of limited life joint ventures or units of a close-ended mutual fund scheme. Close-ended mutual fund scheme come with a lock-in period. After 10 years, we will return the money back to you. After 5 years, we will return the money back. In that 5 years, you cannot demand a redemption. In those 10 years, you cannot demand a redemption. Okay. So these are the two categories of instruments. Okay. Ideally, they should be liabilities. Why? Because if this option is exercised, the issuer will have an obligation to deliver cash. We are in the books of the issuer. Classification is in the books of the issuer. Okay, so that you have to be mindful of. If these two instruments meet the 5 specific conditions, then we can classify these as equity. So what are those 5 conditions? First one. Instruments should entitle the holder to a proportionate share of net assets. To a proportionate share of net assets without any minimum or maximum limits. Without any minimum or maximum limits. Are we clear? So if you are holding units of a mutual fund, you are going to get the amount based on the net asset value that is there on the date of redemption. Yes or no? What is net asset value? Sir, basically net asset value is value of assets after deducting all liabilities. So what is the definition of equity? Sir, equity is a contract that evidences residual interest in an entity after deducting all liabilities from the assets. So can I say that net asset value is nothing but an equity instrument, is nothing but evidencing residual interest? Yes, it is. And therefore, if this is the criteria, if this is the condition that it is entitling you to a proportionate share of net assets based on the number of units you are holding compared to the total units, then yes, that is the first condition to be fulfilled. That is the first condition to be fulfilled. Now, suppose there are certain mutual funds which come with a guaranteed 8% return, minimum 8% return, or minimum you will get 10 lakh rupees. Okay, so if these kind of schemes are there, then you are not getting the NAV based returns. That means your risk is not the same as the one who is subjected to the NAV risk alone. You are getting something preferential, something in a priority order, something more or something less than what is the NAV. And therefore, you are not subjected to returns based on net asset value. And that is why that condition should not be there. So without any minimum or maximum limits. Okay, second one. Second one. Instruments are subordinate to all other classes of instruments. To all other classes of instruments. Okay. That is, they would receive money only on liquidation. They would receive money only on liquidation. Third, all instruments in the most subordinate class have identical features. Fourth, we'll write down the cases and then discuss. Expected cash flows. Sorry. Apart from obligation to redeem, there is no other contractual obligation to deliver cash. And fifth one, expected cash flows attributable to the investment over the life are substantially based on profits or losses of the entity. That is, expected cash flows should be a reflection of performance of the entity. Should be a reflection of the performance of the entity. Is it okay? So these are the 5 conditions. So first one we discussed, instrument should entitle the holder to a proportionate share of net assets without any minimum or maximum guaranteed value. Okay. Second one, instruments are subordinate to all other classes of instruments. That means what? Subordinate means what? They are last in the line to receive the money. Okay. In the time of liquidation, suppose, then you will first pay off preference secured creditors, then preferential creditors, then unsecured creditors, then all that order of payments which you studied in liquidation chapter, that will all continue. And last mein whatever is left, the residual interest jo bolte hai na, that is what these people are entitled to do, are entitled to. Usko hum log bolte hai, instruments are subordinate to all other class of instruments. The third one is all instruments in the most subordinate class have identical features. Okay, have identical features. All the instruments in the most subordinate class have identical features. Apart from obligation to redeem, no other obligation to deliver cash. And the cash flows are largely dependent on the performance. So clearly open-ended mutual fund units are dependent on the NAV. And what is NAV? That is a reflection of the performance of the fund. And therefore, though these open-ended mutual funds, etc., anytime the holders can put it, it is still recognized as equity because a mutual fund will meet all these characteristics. A mutual fund is going to meet all these 5 characteristics. So either of the 2 instruments, if they meet all the 5 conditions, then it would be classified as equity instead of liability. Is it okay? Yes. Are you able to follow? So you will have to test these conditions only if the instrument has puttable features or the life is limited, Okay. So you tend to get confused. See, if you look at this, instruments other in terms of voting power, Now it appears that shares with differential voting rights are going to be excluded from here because though they are subordinate, they do not have identical features. That is not what is the intention of this. Okay, so the standard has given a further clarification by saying that these 5 conditions to be tested only if an investment has puttable features. Only if an investment has puttable features. Okay. Or a limited life. Based on agreed liquidation. Okay. Now, these conditions need not be tested for regular equity shares, which are neither puttable nor carry a limited life. Nor carry a limited life. Okay. That means what? If I have to analyze, you will not start with whether it meets all 5 conditions and look at the instruments. You will start with the instruments and then test whether it meets the 5 conditions. If you start with the conditions first, then you will look at this. All in the most subordinate class should have identical features. And once you look at this, Tata Motors, for example, you can open its balance sheet. You will see differential voting rights. And then you will say, my equity shares do not have like features. One is having a differential voting right as compared to the other. And therefore, you will say that equity shares are not equity in nature. If you start with this, okay. So don't start here. Your starting point will be here. Start here. Check whether it meets the one of the 2 conditions. And if these 2 categories, one of them is met, then you check the 5 basic conditions. If the category of instrument, it falls into that number 1 and you meet all the 5, then the puttable instrument will be classified as equity. Are you okay with it? Yes. Are you okay with this? Yes. Are you okay? Have you understood the exceptions? Yes. Kaushiki, Jahnavi, did you follow? Viraj, did you follow? Tushar, did you follow? Yes. Did you guys understand? Yes. All clear? It's just theory for your knowledge. That's it. Okay. All right. Fine. So that takes care of that. And with that, we kind of draw a tentative closure to what you can say normal accounting for compound financial instruments for off market transactions. Barring some very small issues, we are largely done with the bulk of the standard. Okay. Now what is left is derivative accounting, which I'm starting now. Then what will be left is derecognition of financial assets and financial liabilities. And then we have a couple of models like the expected credit loss model for trade receivables, provisioning, impairment, etc. Okay, so those are all small ones. Those are not the big worries for your examination perspective. Okay, so now coming back to derivative. Okay, so now we start the next one, that is accounting for derivatives. Okay, and this is a little bit important. Okay. Is it unit 4? Okay. Accounting for derivatives. Okay. So now, what is a derivative? What is a derivative? Well, a derivative is an instrument. It is an instrument whose value depends on the underlying asset's value. It is that prepayment, I will do it later on. Okay. Prepayment will do it in the Sunday classes which I'm having. That is, you know the concept. It's just a calculation that is there. That's it. Okay. So we'll be doing that later. But it's broadly done. Okay. I know that it's there. It's there on my mind. I'll be solving it the first thing when we discuss the problems on 4th of June. Okay. So as of now, that is not very important. Okay. Okay. So coming to derivatives, derivatives is an instrument whose value depends on the value of an underlying, number one. So the value depends on an underlying. Second one is it will be settled in the future. It will be settled in the future, and there is no payment initially to be done, or an insignificant payment is going to be done. So these are the three categories or three conditions that have to be met before classifying an instrument as a derivative. इसके अलावा कुछ भी हो, it cannot be a derivative. So when we do the accounting, the first step will be identifying whether it becomes a derivative. Then we proceed to discuss embedded derivatives, split accounting, etc., etc. Okay. All right. Now, what do you think is a derivative? Could it be a financial asset? Could it be a financial liability? Or could it be equity? Could it be equity? What do you think? A derivative, is it a financial asset, or is it a financial liability, or can it even be equity also? What do you think? Derivative yes. For issuer, I don't want now for issuer, for receiver, whatever it is, for holder. Just a simple question. Derivative, is it always a financial liability? Is it always a financial asset? Or could it be equity also? Could it be equity also? It could be. कुछ भी हो सकता है वो. It could be a financial asset. It could be a financial liability. It could be equity also. Sir, example, ESOPs. What is ESOPs? An option to exercise and take the share of the entity. Yes. Is it depending on the underlying of the asset? Obviously, yes. The value of the ESOP depends on the underlying asset, which is your own equity shares. Then the next one is, is it settled in the future? Yes. After vesting period is done, then the exercise will start. So it is in the vesting period. And the last case is payment to be done initially is zero or insignificant. कुछ नहीं होता है. There is no payment initially. It will be done at the time of exercising the option only. So therefore, all these conditions result in a derivative. But what is the derivative for? In the books of the issuer, it is for entity's own equity shares. It is for entity's own equity shares, and therefore, for the entity's own equity shares means that it will become an equity. It will become an equity. Okay, so your accounting for derivatives is going to be based on three things. First one, if the derivative is a financial asset, number one. Second one is if the derivative is a financial liability. And last one is equity. Last one is equity. Okay. So if it is a financial asset, standard is pretty clear. We will do a fair value through profit and loss accounting. If it is a financial liability, it falls in those 6 instruments. Okay. A derivative other than those which are for which you follow hedge accounting. Okay. And last one is equity, value at initial recognition. That's it. No further changes. Value at initial recognition. value at initial recognition. Is it okay? Yes. Are you able to understand? So FVTPL for an asset, for a liability, and equity based on initial recognition. Okay. Okay. So let us understand the accounting with the help of an example. Okay, see, I will do an example that is largely going to be one of the most important examples on derivative accounting. Okay, one of the most important examples on derivative accounting. And once that is done, I think you will be in a position to understand and appreciate whatever we have discussed. Okay. All right. Question number illustration 8. Okay. Let us start. Okay. All right. Hmm. See 12.127. Sorry. Okay. Okay. Entity XYZ enters into a forward contract to purchase 1 million ordinary shares of entity T in 1 year. The current market price of T is 50 rupees per share. The 1 year forward price is 55 per share. XYZ is required to prepay the forward contract at inception with a rupees 50 million payment. Analyze. Okay, so we have to analyze what type of contract it is. Okay, so we have entered into a forward contract. Okay, so don't get carried away by the words. Okay, आप please शब्दों को देखकर जवाब मत दीजिए. You have to analyze the conditions and then you have to come to a conclusion. Okay, the words in a question are meant to cheat you, to deceive you. Okay, to help you give the wrong answer. For example, many students will look at this and they will immediately say forward contract na derivative mein dal do. But what are the features of derivative? First one, value dependent on underlying. Second one, what is the second feature? Settlement in the future. And third feature should be initial payment should be 0 or insignificant. If all these three conditions are met, then only it becomes a derivative. So let us understand. To purchase 1 million ordinary shares of entity T. So what is the underlying asset? The underlying asset is ordinary shares of entity T. Do I have an underlying? Yes. Is your price going to move as per the underlying? Answer is yes. And that is why we are going to say that the first condition is satisfied. Second one, is it settled in the future? Answer is yes, in 1 year. So settlement happens at a future date. Third condition is the payment is insignificant or zero as compared to the whole contract price. Now, if I enter into a price today, a forward price today, then it is 55 into 1 million. So that comes to INR 55 million. Itna to jayega hi jayega. This much will be paid. Okay. But at the time of initially entering into the derivative contract, you are saying that the inception value is 50 million. The inception value is 50 million. Contract value is 55 million, assuming you enter into a forward contract, which is given in the question. And you have to say that initially I pay 50 million. Hurry. Then what is the meaning of entering into a forward contract? Settlement happens in the future means payment also should happen in the future. Now payment is not happening in the future. Payment is happening right now. Payment is happening right now for a substantial amount out of 5550. That means more than 90% is paid now. So is the third condition of insignificant payment or nil payment satisfied? Answer is no. So is this contract going to be regarded as a derivative? Answer to that is again no. Answer to that is again no. It cannot be classified as a derivative. Why? Because the payment made initially is neither insignificant nor zero. It is a significant, more than 90%, 95% of your contracted price is being paid initially. So it is not going to be a derivative. It is not going to be a derivative. Are you clear about this? Yes. Are you clear about this? Yes. Any doubt so far? Yes. Any doubts whether it is a derivative or a non-derivative? Yes, done in totality. Okay. On 1st January, Samco agreed to purchase 20,000 US dollars from JT Bank in future on 31st December 20x1 for a rate equal to 68 rupees per USD. Samco did not pay any amount upon entering into the contract. So is the third condition met? The condition of insignificant or what you call the did not pay any amount, insignificant or small. Is that condition met? Answer is yes. Samco is a listed company in India and prepares its financials on a quarterly basis. Following the principles of recognition and measurement as laid down in Ind AS 109, you are required to record the entries for each quarter ended till the date of actual purchase of USD. Okay, fine. For the purposes of accounting, please use the following information representing mark-to-market fair value of forward contracts. Okay, to be used at each reporting date. Okay, as at 31st March X1, 25,000 negative. As at 30th June X1, 15,000 negative. As at 30th September, 12,000 positive, and the spot rate of USD on 31st December X1 is 66 per USD. Okay, so this is the data which is given in the this is the data which is given in the question. Okay, so now you tell me, is it meeting the definition of a derivative? Is it meeting the definition of a derivative? Yes, it is. Okay, why? First one, is it dependent on underlying? Answer is yes, it's dependent upon dollars. Dollars is a foreign currency, which is a financial asset. So it is dependent in case of what we call, it's dependent on the dollar fluctuation. So there is an underlying. Second scenario, second case is settlement happens at a future date. Is it happening in the future? Yes. On 31st December, today is 1st January 20 X1. So on this date, settlement not happening. Settlement happens after 12 years. And finally, are you making any payment right now? Answer is no, you are not. Okay. So that is how we have come to the conclusion that this contract is a derivative contract, And when it comes to accounting of this, we will have a look at it in the next class. Okay, because 15 minutes is too short for me to even start the accounting. Okay, so we will be discussing this in the next class. Is it okay? Yes, that is tomorrow. Tomorrow we straight away jump into this question. Okay, anybody has any doubts to discuss, any issue or anything, any query, any clarification, anything is left to discuss? Yes. I would want to take it, but it's a massive question. Tomorrow I'll need at least 1 hour to kind of wrap up this question. Okay. So we'll do it tomorrow. Thoda time jayega. Tomorrow I'll be extending the class by about an hour or so. Okay. Namrata is not there today. Namrata, no answers from her side. Is there? She has come. Yes. Tushar, did you follow? Viraj, did you follow? Shubham, did you follow? This is 12.197. Okay. 12.197. You can, if you want to try, you can try. But my advice is, if you have not done before, please don't try it out. Kal kar lenge, aaram se kar lenge. You will be able to understand it. Okay. All right. No other doubts, everyone? No other doubts? Janvi, any doubts? Kaushiki, any doubts? Namrata, Viraj, Tushar, any doubts? Yes. No doubts. Okay. So that takes care of our class for today. We shall resume tomorrow. Okay. Tomorrow we should be in a position to kind of wind up derivatives and hopefully embedded derivatives. I'll try. Okay. So let us see how it goes about. Okay. That's it then. Thanks everyone. Okay. See you guys tomorrow. I will put up the notes today. The handwritten notes I will be uploading, and over the next week I will be uploading the theory with question references of all what we have done and the questions which you can do for homework. Okay. So I will be uploading a very comprehensive sheet in the coming week. So that should kind of, take care of what all we have done and what you can be doing. Okay. So that should be fine. All right. ठीक है, तो we conclude the topic. Yes, thanks everyone. Thank you. Sir, lecture concluded. Yes. Okay. Nobody else has any doubts. Okay.